Imagine this. You have $1,000 to invest. Would you prefer to lend it to a company and earn a steady interest, or would you rather own part of the company and grow with its success? Welcome to the world of debt and equity markets. Two pathways to investing, but with very different rewards and risks. In this video, we'll break down what the debt and equity markets are, how they differ, when investors choose one over the other, plus real-world examples to make it clear. Let's start with the debt market. In simple terms, the debt market is where investors lend money to companies or governments in exchange for bonds. These bonds are like loans, but with a twist. Let's get familiar with some terms related to bonds. Principal is the original amount you lend, let's say $1,000. You earn regular interest payments, like 5% annually, which is called interest or coupon. Maturity is when the company or government pays back the loan in full. Let's look at an example. If you buy a 10-year U.S. Treasury bond with a 5% interest rate, the government will pay you interest equals to $50 every year for 10 years. Also, at the end of the period, you get your $1,000 back. Now, most bonds pay regular interest. But there are also other types, like zero-coupon bonds, where you don't get periodic payments. Instead, you buy them at a discount and get the full value at maturity. We'll cover it in more detail in a later video. Well, what is the equity market? Here, instead of lending money, you buy ownership in a company by purchasing stocks. This ownership gives you two main financial benefits, dividends and capital appreciation. Some companies share their profits with shareholders through dividends, like earning $2 per share annually. For capital appreciation, if the company performs well, its stock price increases. For example, if you bought shares for $100 and its price grows to $150, you make a $50 profit for each share you hold. But unlike bonds, there's no guarantee of regular returns in the equity market. Stocks are riskier, but they also offer higher potential rewards. Now that you know what bonds and stocks are, let's compare the debt market and the equity market side by side. In the debt market, you're acting like a lender, giving money to a company or government. In return, they promise to pay you back with interest. In the equity market, you're buying ownership. You own a small part of the company and share in its success or its failure. Bonds give you predictable, steady interest payments, like receiving rent from a tenant. Stocks, however, don't promise regular payments. Instead, you profit if the stock price grows, or the company pays dividends. The trade-off is risk. Bonds are safer but give lower returns. Stocks are riskier because prices can fluctuate, but they offer higher potential rewards. Finally, bondholders have no ownership rights. You're just a creditor. But stockholders get voting rights and a say in company decisions, like attending annual meetings. So to sum up, think of bonds as a safer, slower journey, like driving at a steady speed. Stocks, on the other hand, are like flying, faster, riskier, but with greater rewards. Now, we're going to talk about a real-life situation to see how investors may use debt and equity markets. Let's think of an investor with three options to do with his or her extra money in the middle of 2023. 1. Buying Apple bonds, 2. Buying Apple stocks, or 3. Depositing the money in a current account. In 2023, Apple issued corporate bonds to raise $5 billion. Investors, who have bought these bonds, earn steady interest payments, like 3 to 5% annually, while Apple used the money to expand its business. So, in this case, the investor would get a profit of roughly $60. At the same time, people who bought Apple stock benefited as its share price grew. If you bought Apple shares in June 2023 at $190, they're now worth around $250, which is around 30% profit. Our hypothetical person would gain $300 in this case. Also, our investor could do nothing with the extra money and deposited it in a current account. As a result, he or she would not make any profit. So, while bond investors earn safe, predictable returns, stock investors took on more risk but enjoyed higher rewards. Please bear in mind that this is just an illustration. So, it is not always true that investing in the stock market would yield higher returns, as it could be the opposite, and the investor could have lost money. So, when should you choose debt or equity? If you're a conservative investor looking for steady income with low risk, bonds are a great choice. If you're a growth-oriented investor willing to take risks for higher returns, stocks are your path. And for a smart strategy, most investors combine both bonds and stocks to build a balanced portfolio to get safe, steady returns from bonds and to gain growth potential from stocks. To recap, debt markets involve lending money through bonds for safe, steady returns. Equity markets involve buying stocks for higher risk and higher rewards. The choice depends on your financial goals and risk tolerance. Thanks for watching. If you find it worthy, please hit the like button and subscribe to fathom out more on finance. Next, we'll dive into how bonds work.